and the web. Gary, thank you so much for moderating our esteemed panel this afternoon. Take it away.
Lauren, thank you very much. Appreciate that. And as Lauren said, welcome everybody to Jmore's inaugural Your Finances, Your Future event. Here's what our goal is today. Our goal is to provide you with useful and important information as you build your financial future. It's quite as simple as that. Here are the things that we're going to discuss. Financial planning inside your business. What are your options? What is the methods? What are the tools that you can use to save and invest the most amount of money possible over years? Insurance. What do you need? What do you not need? What do you not know about insurance? Maybe little pitfalls or some exclusions that you may want to know about. If you're starting a business, what corporate structure should your business take? What are your options? What are the tax ramifications of those structures? And finally, valuing your business. How do you do that? And if you're planning succession in your business, what are the steps to doing that? So again, these are important topics for building financial wealth as we move towards retirement, and we're going to discuss all of those here today. I'd like to start by thanking our sponsors, as Lauren mentioned, for without them, this does not happen. CCBC and their 10,000 small business program, Glass Jacobson, Heller Kowitz Insurance, the law practice of Levy, Mann, Caplan, Hermann, and Polashuk, and Nemphos Braue, LLC. Our lineup of speakers here today are as follows. Very esteemed, very expert in all of the areas that we just talked about. Byron Deese from Glass Jacobson will be joining us. Steve Heller from Heller Kowitz Insurance will be here. David Polashuk of LMCHP, and George Nemfos, one of the founding partners of Nemphos Braue. Now, here's how this is going to go. We're going to be here for probably between 60 to 75 minutes. I know it's beautiful outside and timing is everything. And here we are sitting on a Zoom call, but we're going to make this as entertaining and as informative as possible. It'll be time well spent. We're going to be bringing our speakers on one at a time to give their insights into their areas of expertise. Should be here again like for about an hour. And we'll be taking questions live from the audience via the Zoom chat function. Everybody has that and is available to do that throughout the program. And an FYI, this program is running concurrently on Facebook Live, as Lauren mentioned, and will be available on Jmore's YouTube channel and on jmoreliving.com. Please share the program with those in your world who could benefit from this content. Also, contact info for each speaker that we have today will be available to you in the chat. Let me give you just a little bit of background on our sponsors here today. Goldman Sachs and the 10,000 Small Business Program through CCBC is an educational and leadership program which is designed to help business owners discover best practices for growing their business through finance metrics, marketing, negotiating, leadership, and other topics. The program is free. 70% of their graduates increase revenue within the first 3 months of completing the program, and 99% of their scholars do in fact complete the program. It's like an accelerated, customized MBA program for small businesses, if you will. Rod Bourne runs the program. Rod's contact info will be on the chat, along with those of the speakers that'll be joining us this evening. Glass Jacobson. So what does Glass Jacobson do? It's quite simple. They empower their clients. To be more specific, they empower their clients to build wealth. Whether it's business endeavors, investment choices, or tax strategies, Glass Jacobson Financial Group provides unparalleled guidance. And the result is businesses that grow and clients that are happy. You really can't get much better than that. Their URL is glassjacobson.com. Heller Kowitz is an insurance advisor, a full-service independent insurance agency. Steve Heller, Brian Kowitz, good guys. Brian played in the majors, by the way, for the Atlanta Braves. You may want to ask them about it. Their understanding of both personal and business life cycles allow them to provide customized insurance solutions. They specialize in strategic insurance planning for both personal and commercial clients. Their business is built on their ability to protect the one asset that can never be replaced: peace of mind. Their URL is hellerkowitz.com. Levy, Mann, Caplan, Hermann, and Polashuk. Since 2001, LMCH&P has provided quality legal services to clients throughout Maryland. Their attorneys and staff address a wide range of business, real estate, tax, and family law matters, and other matters for clients ranging from individuals to large businesses. The attorneys of LMCH&P include skilled litigators and advisors ready to assist you, your family, and business in a wide variety of legal matters. And their URL is lmchplaw.com. And finally, last but not least, Nemphos Braue, proven experts with a dedication to their clients and the law. Nemphos Braue attorneys are accomplished counselors in all areas of corporate law. Their diverse practice and business experience, education, and interests shape the culture and set the standards of outstanding value that they provide to their clients. And now for our program. Here are our speakers, and we're going to do it alphabetically as democratically as we possibly could. First up is Byron Deese, who will be joining us from Glass Jacobson. Byron, welcome in. How are you?
Good evening. Good evening. How are you?
I'm good. Thank you. Byron, I've got a really long, impressive resume on you that was written for me that they wanted me to deliver, but
Oh, no.
You can deliver it better than I can. So why don't you give us a little bit about yourself, what you do, and who you are?
No, perfectly. No, thank you. Thank you so much for that. My name is Byron Deese. I'm the relationship manager and the retirement plan manager for Glass Jacobson Financial Group here in Owens Mills, and we have an office also in Rockville, Maryland. And we really focus on providing tax, accounting, and investment advisory services for small business owners. And that's really important when we think about the relationship between our services, professional services, and the small business owner. And I like to think about it in the way of working with innovators, people who are creating things, creating parts of what we experience on a day-to-day basis and helping them through their financial journey. Personally, I'm originally from Sanford, Florida, studied finance at Tuskegee University in Alabama, and have been in the Baltimore area since 2004, where I married my wife, who's originally from here. And we have one daughter who's 9 years old, turning, seems like she's on her way to 40. but we really enjoy it here, and just having a great time working with families and businesses here in the area.
Well, you, like me, are a transplant. I've been here for 33 years, Byron, and I can tell you, once you come to Baltimore, you never leave. So yeah, thanks for joining us, and thanks for doing what you do. So let's get into it. Glass Jacobson, the topic of retirement and financial planning. Obviously, this is on everybody's minds. What are the different types of retirement plans that are available for small business owners inside their business?
That's a great question. And especially when you think about there's kind of a growth cycle, if you will, relative to businesses and where you are in business. And so if you are, say, a single member LLC or a sole proprietor, and when you look into the future relative to your business, you can kind of only see yourself and maybe one or two people from a staffing perspective. You know, in those type strategies, you could easily establish, say, a solo 401k, or what's also called a SEP plan, which is a simplified employer pension plan. There's also simple plans, but I would say for those who are more of the sole proprietor, single member LLC, either the SEP simple employer plan or the solo 401k, which is, if you're familiar with the normal 401k, that's the best strategy where it's just for yourself, and it allows you to fully maximize the benefits of contributing to a 401k. Also, if you are a business that's growing and you foresee having, say, 10 or more employees, and you want to also provide, say, a nice benefit for those employees, whether it be a matching contribution or an employer non-elective contribution, then definitely a 401k plan would be a great strategy. But it's also important to recognize that when you're taking a look at the type of employee that you have and how that employee is being compensated, you may also want to look into, say, a safe harbor 401k plan, which would help you to manage some of the non-discrimination testing, and just kind of not to get too technical, but for those, if you're hiring employees, say, above 100,000 a year, and the majority of your workforce is earning at that level, or even if you have those who are earning less than that, you want to make sure that you're meeting those non-discrimination testing laws. And so when you're able to provide, say, a 4% contribution, whether it be a matching contribution to your employees or a non-elective contribution, it really helps you to navigate those testing rules that you have to provide each year for the Department of Labor. And even for those companies who say, well, you know what, in the future, and as you're looking further into the future, I may want to sell my business at some point, and I'd even be interested in having my employees purchase the company from me. So you can also set up what's called a Esop plan, which is an employee stock ownership plan, which allows your employees to participate in that process as you look into the future and thinking about ways to possibly sell your business at some point in the future.
If anyone wants to ask a question to Byron or really any of our participants here today, please let us know by saying so here, and we'll open your mic at the appropriate time. Byron, let me continue on. COVID has changed everything. Hopefully it is coming to a close, although obviously no one knows exactly when. But one of the things that I've noticed through COVID, even within my family, is someone's got a full-time job. They may not be going to their full-time job at the office like we've been doing forever, working from home. And now ideas pop into people's heads. Maybe they want to open up what some people may call a side hustle or a side business or something like that. What advice would you give to somebody who is working full-time, whether they're in the office or not? They do want to open up their own small business. And from a retirement planning perspective, or just advice in general, how would you recommend somebody go about doing that?
This is a great question, because retirement, especially now in the era of COVID, we begin to think about retirement differently.
Yeah.
Especially in the past, we'd say, well, I'm going to work hard until I turn 60 years old, and then I hope to turn it all off and not work anymore. And that's kind of the old traditional model for retirement. But nowadays, people are really beginning to say, there are things that I'd like to do other than what I'm doing right now, and even other than what you studied. Or maybe there's some people who went full time into something that wasn't relative to their actual degree or their areas of interest. And they say, I want to at some point end what I'm doing now and prepare to go into that. And so I definitely think that a great way to think about this is how are you going to capitalize that business? And even before, say, going to the banks or looking for investors and things like that. At the end of the day, if your goal is to try to retire from a particular business to go into something else, then you can do that. You can say, hey, you know what? I want to fully fund my current retirement plan up to the IRS limits. So if you're under the age of 50, you can contribute up to $19,500 a year. If you're over the age of 50, you can contribute up to $26,000 a year, and make that a part of your immediate budget, because you have another plan that you'd like to retire in the next 5, 10, 15 years. And what's interesting is that you can actually take your retirement, retire, set up your own, as we talked about earlier, a solo 401k. You can roll your money into your solo 401k. You can take a loan from that solo 401k, tax-free, and put yourself in a position to capitalize your business even before having to knock on the door of your banker or go around friends and family and ask for some dollars to help start your business. You can strategize and prepare for that, and you don't have to have this crazy tax bill coming because you took a early retirement withdrawal from your retirement plan. And so there are strategies and ways to approach that as well.
Next question, Byron, and thank you for that. Just a general question. And I know that a lot of different people have different personalities, They have different risk tolerances. Some are conservative, some are more aggressive, etc. How should retirement plan assets be invested? And how do you figure out what your personality can handle?
Yeah, I would highly recommend doing what's called a risk tolerance questionnaire, completing that, which would help you to get a better understanding. It gives you all the questions relative to your history with investing and what amounts have you invested, how long have you participated in, say, retirement plans or savings that had some form of a investment that was above, say, a bank note or an interest rate associated with the banks. Anything above the FDIC insurance, that's when you know you've kind of moved into the investment world and outside of just the bank guarantees. But I would really associate your retirement investing, more so align that with how soon you plan to use the money. And so if your objective is, well, you know, I plan to retire in the next 7 years, I always use the rule of thumb of say, well, I'm going to take, you know, say 10 years. And I'm fully in the markets for 10 years. But every year that I get closer to using the money, I take 10% out. And so some people may say, well, wow, I mean, I plan to retire in the next 10 years, but I don't feel comfortable with having all of my money in the stock market. That's the reason why the risk tolerance questionnaire is so important, to really help you to gauge your risk and your risk levels. And so when you combine those two, how soon you plan to retire and how your comfort level with risk, that will help you to identify the type of, you know, large cap stocks, small caps, how much should be in bonds, that conservative, moderate, and aggressive strategy for your retirement.
And a final question for you, Byron. And I'm sure everybody knows what these are, but may not know the differences between a Roth IRA and a traditional IRA, or even a Roth 401k and a traditional 401k. Can you explain what the major differences are?
Yeah, definitely. And so with the Roth, well, the traditional retirement contribution, whether it be through a 401k or an IRA, is every dollar that you put into that retirement plan reduces your taxable income. And so it's a great tax strategy for those employees who are really trying to earn as much money as possible, and their compensation continues to increase. They're looking, at the end of the day, you have to find as many deductions as your compensation continues to increase. But for those who, especially those newer employees who are just fresh out of college, they have time ahead of them, and they may be at the beginning of their earning level. And so at that point, they're able to make contributions from a Roth perspective after tax at the current tax rate. So if you're in a lower tax rate, then it's great that you're able to make those after-tax contributions now, and then to have that money grow tax-free. And this is so important because at some point we're all going to retire. And when we look into the future, I mean, if I don't have a crystal ball, but I would assume that taxes are just going to go up. And so if we're in a position to say, well, we've already paid taxes on that money, so we're going to receive that retirement income tax-free, which is a huge, I mean, I can't begin to tell you how important tax-free income is, especially as we get older, when our budget may have medical expenses and all types of things that weren't on our current budgets when we were younger. And on top of that, during our working years, there were so many different opportunities to reduce your taxable income, like 401k contributions, health savings accounts, all these different things that would help you to reduce your taxable income. Many of those taxable benefits go away when you get older. And so the benefit of being able to have tax-free income is just a home run during your retirement years.
Well, Byron, we really appreciate you being here with us. How can people contact you if they have any further questions?
Yes, and thankfully I do see in the chat here my the website and my phone number and email address is there. So definitely feel free to contact me directly. Byron.Deese at Glass Jacobson IA. That IA is the investment advisory group. So GlassJacobsonIA.com.
Byron Deese from Glass Jacobson, thank you very much. We really appreciate you.
Thank you.
You got it. Okay, let's move on from financial preparation and financial planning from within your business to the insurance world. Steve Heller from Heller Kowitz is here to join us. Steve, welcome in. How are you today?
Doing well. Thanks for having me.
Steve, it's always good to see you, my friend. Thank you. Just like I did with Byron, why don't you give us a little, 30 or 60 second on you, what you do, who you are, and why you wake up in the morning.
I will say that, I'm the founder, one of the partners here at Heller Kowitz Insurance Advisors. As I explain to people, I have a real passion around insurance, and I think that just stems from the fact that I've always liked to help people overall. And so just from that perspective, being able to be a part of this, not only being part of the community, but just being part of the family here has been just wonderful. As far as on the personal side, my wife and I, we reside in Reisterstown. Got a small French bulldog named Isabel, who brings us a lot of joy. And other hobbies, I like to hike. I like the outdoors. I'm involved with an organization called Climb for Hope, which has been wonderful. We went on an expedition 2 summers ago, which I had a really great experience, not only with other people, but just getting out there, and again, just a different experience in life. So.
Yeah, no, that's excellent. I have it here, actually. You were up at El Dorado Peak in the North Cascades, way up there. Yeah, congratulations. That must have been awesome.
It was.
Okay, so let's talk insurance. Give us an overall. Let's say I come to you and I'm looking to find out information about what I need, what I don't need. How do you even begin the process, Steve, of evaluating somebody's needs and designing a program for them?
It's a good question. I think we start with more of an order of operation. And when we look to see, where's the entry point with different clients? Now, our business is really built around a few different areas. We help on the personal side with any personal insurance. We also help business owners in a variety of different capacities with different business insurances. But really, the approach is really somewhat the same in that we first want to understand what needs to be covered. A lot of clients that come to us for a variety of different reasons. One, they just maybe just want a second opinion, or maybe their insurance hasn't been reviewed in a long time. And what we find are a lot of policies are really outdated. They just really haven't been kept up. So really what we do is we take a lot of time in understanding what needs to be covered first. Now, the whole time is as we go through any type of due diligence or discovery, we want to make sure that the customers, the clients that come to us feel at ease about talking about what their real needs are. So the first thing is what we want to do is really uncover what actually needs to be covered. So we spend time with them, reviewing their exposures, again, whether it be on the residential side, whether it be on the business side. And then we come to really an agreement on the types of coverages and types of plans that are necessary in order to respond in the event of claim. From there, we go out to market. We have over 30 insurance carriers we work with, a lot of choice, a lot of flexibility. And so through that whole process really is that we come with a plan that is designed around claim, because ultimately that's what you're buying. A lot of times people obviously have cost in mind. We offer very competitive solutions, but I feel where a lot of people err is they let cost be the main decision maker. What we do is we kind of correct that thinking a little bit. Obviously, cost is the factor, but ultimately, what do we need to protect? And that's what we do. We empower our clients by educating them at a higher level about key coverages that will help secure them in the event of claim.
So that's a good point, Steve. Let's talk a little bit more about claims versus cost. Okay, so a couple of questions. What types of coverages are available out there that are on the market, which a lot of people may not be aware of, which have claim impact should a loss occur?
Yeah, And I'll answer that really in two ways. On the personal side, we see a lot of neglect there. Again, there are a lot of direct writers, a lot of clients are putting together policies, again, based on the low cost provider. But when they come to us, what we'll do is we'll look at some key coverages. So for example, we go back to the basic replacement cost around a home. Now, the reason why I bring that up is because the market's changed dramatically.
Yeah.
The cost to rebuild a house has significantly increased. And a lot of times people get confused between market value, what it's going to cost, what's going to be involved to sell your home, versus replacement cost, what it's going to cost to rebuild your home.
Mm-hmm.
And so that's a key distinction. And a lot of times when we review policies, specifically homeowner policies, we find that a lot of times the replacement cost needs to be adjusted to make sure it responds accordingly. Now, to add some additional coverage around that and to be relevant, we'll add these additional replacement cost coverages to make sure that in the event of claim, our clients aren't going to necessarily run out of coverage. So the carriers are offering extended replacement cost endorsements. They're offering coverages around service line, and that's that line from the house to the street. So if there's any underground piping that needs to be excavated in the event of claim, we'll make sure those coverages are there. From a liability perspective, what we're finding, especially because we're operating more online today, around personal liability, so that's libel and slander. So if you or you're blogging or your kids are out there online, if they defame anybody, there's any lawsuits that come about that, because we are in an online environment, we want to make sure we have enough personal injury protection. We also want to make sure that the umbrella responds. A lot of times, clients that come to us may not have the right level of liability, and we'll recommend umbrella policies. But a lot of times those umbrella policies are outdated. Maybe at one point they started with $1 million in protection. However, their portfolios have really grown. And so from there, we'll offer higher liability limits to make sure that they're protected. On the business side, again, there's a whole host of coverages out there today that I feel that are very relevant, from employment practices liability. We find a lot of our business clients don't necessarily have that or know what that is. Employment practices deals with wrongful termination, defamation, harassment. And again, that's an easier plan to put together for business owners to make sure they're protected. We also evaluate cyber liability plans for our business owners to protect against ransom attacks, to protect them against third-party liability, business interruption. So there's a whole host of coverages today that I feel that as brokers, with our firm, we will, again, it's really important to have those policies be relevant. And that's what we do.
Steve, you talked about costs. I'm sure, everybody likes a deal, right? You buy insurance, you hopefully never use it.
That's right.
So people shop, right? Sometimes they shop every year for insurance. What's the best deal out there, quote unquote? Can constant shopping and changing of policies from one company to the next have a negative impact on your coverability? I
wouldn't necessarily say on the coverability or your ability to be insured. If we're trying to reach a certain competitive price point from one carrier to another, we may not be able to achieve that objective. The reason why I say that is, in this marketplace today, carriers are looking for loyalty. They're looking for longevity. On the personal insurance side, more so than ever, we see clients where we write a plan in year one. In year two, we may see some price variances for whatever reason. Maybe it's a general rate increase. Maybe there's been some claim activity. And we find some clients that just want to jump from one carrier to another. We caution against that because with the savings sometimes that you may realize in the short term may be dissolved in that second year with that new carrier.
Gotcha.
The other thing is that when it comes to receiving renewal credits, again, carriers are rewarding you for longevity. So in years 3, 4, and 5, carriers are going to reward you in higher retention credits. That's on the personal side. On the commercial side, what we find equally there is underwriters want to get comfortable. Carriers want to get comfortable with you as a business owner. So maybe that first year is more of, hey, that's more of like an audition. Are you going to be profitable? Are you going to mitigate claim? Are you going to protect us? And then in year 2, okay, that's an opportunity to come back and reflect on what happened in that prior year to make sure that we're maximizing on all of our credits. Now, a lot of times, business clients, when it comes to insurance pricing, it's negotiable. Personal insurance is not negotiable. However, commercial insurance rates are.
Wow.
And that's our job as brokers to negotiate the best pricing given longevity, given mitigation, and given overall performance. So that's why if we see small price adjustments, it's not that we won't go and look at other viable markets. It's just, what are we looking to achieve in the long term?
And a final question, Steve, along those lines, is there a way actually to save on premium but not compromise coverage?
Yes. And this really hits a lot of the core of what we do as well. There comes a point where you either look at your insurance as a cost or you look at it as more of an investment to protect what you've worked hard for. And it's not, look, not everybody takes on that mindset. I would argue that if you have assets and you desire protection, that you start to look at your insurance as more of an investment in that protection. So meaning that when we look at deductibles, for example, again, we hear this a lot. Well, they're just going to look at my deductibles. But when we look at your life cycle, whether it be your personal life cycle, whether it be your business life cycle, well, where you started as a small business or maybe starting out as a newly married couple could be very different from where you are today. So let's say on the residential side, you have $1,000 home deductible, but today you can afford a $2,500 or a $5,000 deductible. And again, the reason why I'm bringing this to light is if you have more of an opportunity to self-insure a little bit, carriers are providing big discounts. And that's what they want to see. They want to see clients have a little more skin in the game to release some of that additional pricing.
Gotcha.
In addition to that, there's technology. And what a wonderful industry as far as the insurance to incorporate technology. So what are we seeing? On the residential side, if you feel like you're overpaying for your auto insurance, we are moving to more of a usage-based environment. What does that mean? It means that the carriers are coming out with technology to reward you for your performance. So if you're a good driver and you don't speed, you don't have a lot of accidents, well, there's technology that will track that and will reward you accordingly. And that's the direction we're heading in. On the commercial side, equally, there's technology there to make sure that you can take advantage of this to earn some additional credits. Again, we're not lowering coverage, we're not compromising coverage, we're just utilizing different techniques to achieve premium savings at the end of the day.
Sounds good. Steve, do me a favor. Tell Brian I said hi. And,
I will.
Thank you very much for joining us. We really appreciate it.
No problem. Thanks for having me.
Absolutely. That is Steve Heller from Heller Kowitz Insurance Agency. Now I'd like to introduce our next guest. It's David Palashuk, a principal partner at Levy, Mann, Caplan, Hermann, and Palashuk. David is a 1989 graduate of the University of Maryland School of Law, where he was admitted to the Order of the Coif for graduating in the top 10% of his law school class. David, quite an honor. Congratulations. Welcome in. Tell us a little bit more about yourself, please.
Well, I'm a CPA by training. I went back to school at the age of 25 to become a lawyer because I liked law more than accounting. And I know there's some really good accountants on here. I see some familiar faces and organizations. Brian, I don't know you, but I know Eddie and Stevie and the rest of the guys. And Alan, I see you're here somewhere. So I see a bunch of familiar faces here. Me and my two original partners left the big firm world in downtown Baltimore to set up our own shop and improve our lifestyle a little bit. But we come out of a big firm environment, but we do big firm work. I think it's smaller firm prices. We have good quality and a large range of what we do. We pride ourselves on helping our clients solve their problems. I really appreciate Lauren giving us the opportunity to talk today, giving me the opportunity. And we're trying to come up with a subject. And it seems to kind of fit in because it's been mentioned by Brian and by Steve. We decided I'd talk a little bit about choice of entity. Now, George, I know George is going to talk after this, and it appears to me from looking at him, maybe he's working on some larger, maybe public offering, more larger businesses, maybe. Although we represent large businesses, we don't do public offerings and we don't do things like that.
Yeah, certainly. Let's just go ahead and talk about it. What are the different entity choices that somebody can make if they are wanting to incorporate?
We can start from the bottom and work our way up. Of course, the most basic entity is a sole proprietorship. And a sole proprietorship really isn't an entity at all. It's just you. And, I listened to Steve talk about insurance and, planning and Brian talking about protecting your retirement money and things like that. Well, the most important piece of insurance I believe you can have when it comes to choice of entity is to have limited liability. And limited liability means not being a sole proprietorship. It also means not being a general partnership. Because if you're a general partner or a sole proprietor and your worker in the company vehicle runs down a 38-year-old orthopedic surgeon with 5 kids, you better have a lot of insurance from Steve or else you got a big problem. So number one, you want limited liability. So what are the choices when it comes to forming a company, forming a business with limited liability? Well, in the old days, you could form a limited partnership, which gives the limited partners limited liability, but there's still got to be a general partner. Oftentimes that general partner will be a corporation or some type of limited company that gives limited liability. But, that's where, and I'm showing my age because I remember when LLCs were created. So the next entity is the LLC. And an LLC stands for a limited liability company. It gives you that limited liability. A single member LLC is a disregarded entity for tax purposes. So you don't have to file an extra income tax return. You can file it on a Schedule C on your individual return. And, a startup business is looking to save money. An LLC is easy to set up, especially a single member. It has a lot of flexibility and you have your limited liability. We'll talk about the tax aspects in a little bit. if you're not going to be a LLC, you can be a corporation. Now, people talk about, are you a C Corp or are you an S Corp? Well, a C Corp and an S Corp is a distinction for tax purposes only. It has no distinction for corporate law purposes. Corporations, Maryland corporations, give you limited liability. What limited liability means, whether it's a corporation or an LLC, it means that they can't touch your personal assets. When the company truck runs over the orthopedic surgeon, I hope there's no orthopedic surgeons or anybody here.
I hope nobody runs anybody over.
I hope nobody runs anybody over. And, but when that happens, and you get the $10 million verdict against your company, and you didn't buy enough insurance from Steve, and you just have to, you're out of business.
Yeah.
Call it a
So,
day.
yeah. So David, let me ask you though, if I live in Maryland, do I have to incorporate my business in Maryland? And if not, are there advantages, disadvantages? Does it matter?
Well, I'm gonna defer a little bit to George on that, but what I would tell you is this. If you're a small business and you're really only doing business in Maryland, I don't think there's a good reason to incorporate anywhere but Maryland.
Mm-hmm.
People talk about Delaware corporations, and there's some advantages of a Delaware corporation. Supposedly, they're a little bit more corporate friendly. They have a court that's specifically designed for business cases, and the courts are supposed to be business friendly. But if you're operating in Maryland and you have litigation, you're going to be in court in Maryland anyway. If you're operating in Maryland and you're a Delaware corporation, you're still going to have to register your business in Maryland, and you're still going to have to pay a fee to Maryland and Delaware. So if you're a smaller business, I don't see a reason to be anywhere but Maryland. Let me talk, so you've got the sole prop. If you have any liability concerns at all, you shouldn't do that. Then you've got to limit the LLC and the corporations. People ask me, oftentimes I'll come in and, we're going to set up the business and they're going to have a partner, or, the guy comes in and he wants to make his wife, who's going to be the officers of the business. Well, I think I'm going to make my wife or my son, my infant son, the officer, because I think it'll make him feel good. My advice, take her out to dinner. Don't make her the officer, because when you become an officer, you could be subject to liability. And of course, it could be the woman that's forming the business. Don't make the husband the officer either. Keep it separate. And then people will say to me, I'm going into business with my best buddy. We've been friends forever. Do we need an operating agreement in our LLC, or do we need a shareholders agreement? We're like brothers or sisters. We'll never, we'll always be able to work things out. And, do I need a lawyer for that? Well, if there's more than one member, there should always be a shareholders agreement or an operating agreement in LLC. And then, the clients ask the famous question, do I really need a lawyer for this? Can I just do it myself? And my patent line is, when my toilet breaks, I call a plumber. So that's, to hit the high points, limit your liability, keep your personal and your business stuff separate. And people always say, I am a tax guy. I mean, I spend most of my days fighting with the IRS in the state of Maryland. So I'm a tax guy by trade. What are the tax differences between these various entities? Well, an LLC is taxed as a partnership unless you elect to have the LLC taxed as either an S Corp or a C Corp, which you can do. A partnership, income from a partnership is subject to self-employment tax, which is Social Security and Medicare. So sometimes it makes sense to elect to be treated as an S corporation. Now, with an LLC, and I mean a partnership, the income flows through to the partners. There's no tax at the entity level. Same thing with an S corporation, which is a corporation where you can make an election to be treated as an S corp. Again, the income flows through. The rules with regard to S corps are a lot stricter than with an LLC. However, the advantage sometimes is that your flow through profits out of an S corp are not subject to self-employment tax, Social Security. That said, you have to pay yourself a reasonable salary. The government really doesn't like when the owner of an S corp, especially when it's a small business and you're the only one, doesn't pay a salary and takes all the money out and skates on the
Social Security.
Social Security and the Medicare.
Yeah, I got you.
So, and the government, I've had cases where the government has come in and recategorized those distributions as wages and hit you for the employment taxes. A C Corp is taxed at the corporate level. So your profits in a C Corp, there's tax paid by the corporation. And then if you want to get the money out, you have to pay tax again. So generally speaking, I guess there could be exceptions. Generally speaking, in a small business, a C Corp, in my mind, is generally not a good idea.
Yeah.
If you are going to be a C Corp in a small business, you better have a really good accountant, and you better really have your accountant look at the numbers before the end of the year to make sure that you can pay out the profits. Brian's smiling, that you can pay out the profits in the form of a bonus so that the money isn't trapped in the C Corp.
David, quick question, final question. When you say a small business, like what's the ceiling? Is it 100,000 in revenue, 500,000 in revenue, $1 million in revenue? What are we looking at?
I mean, look, as a tax litigator, what I see at various size businesses going up to be very big, I see nightmares with C Corps where people are running personal expenses through the business. And I see the nightmares because I see when they get audited. If you get audited in the C Corp and you deducted, inadvertently, not intentionally, but you deducted some personal stuff through the business, and they come in, not only are they disallowing that deduction at the corporate level, and the corporation has to pay tax on that money, but they recategorize those payments as dividends, and now you're paying tax on it too.
Yeah, personally.
Yeah. I think, and George may be able to touch on it. I think, if you're gonna be a public corporation, if you're going public, you probably got to be a C Corp. if you're, you know, there's reasons to be a C Corp. I mean, under the new the Trump tax law, they cut that C Corp tax rate down tremendously. And if you're not distributing money out and you're reinvesting the money in equipment or whatever it is,
It's good. Yeah.
maybe it makes sense.
Gotcha.
You know, but you know, if you, again with the C Corp, if you take too big of a salary, the IRS is they're interesting. When a C Corp, when you take too big a salary, they say the compensation is unreasonably high because they don't want to give you the deduction at the C Corp level. With an S Corp, when you take a low salary, they say your compensation is unreasonably low because you're aiding on the Social Security. So
yeah, one way or the other.
one way or the other. So what I always tell people though, when they come to me, and this goes back to I think what Brian said at the beginning, come to me, I want to form a business. You know, we can form the business, we can do the operating agreement or the shareholders agreement, we can do all that. But I think before you do it, before you're going to go into business, it's even more important to get yourself a good accountant and run the numbers and make sure your business is viable before you start sinking money into it.
Yeah.
You know, so anyway, I'm open to any questions and I really appreciate the opportunity.
David, thank you very much. We really appreciate you being with us. And yes, any questions, please Zoom us and let us, or please chat with us and let us know. Last but not least, let's go to our final guest, somebody I consider a friend, known him for a long time, George Nemfos, founding partner of Nemphos Braue. George is a founding member, a mid-Atlantic boutique law firm, representing entrepreneurs, startups, emerging and mature companies, as well as venture capital and private equity funds. George, why don't you give us a little 60-second on yourself, and we'll take it from there.
Thanks, Gary. Appreciate it. Thanks for having me today. Always happy to be a sponsor and be on with Jmore and to see your smiling face.
Thank you.
So Nemphos Braue was formed by a bunch of former big firm lawyers, unlike David. We tout ourselves as big firm expertise, boutique service. It's kind of our tagline. You know, having spent a majority of our careers in large firms, we experienced what a lot of lawyers experience at these monolithic firms. You know, you're a number, you're a cog. You don't really get an opportunity to really sit down and help your clients. And I started out back when it was Piper Marbury, went all the way through to DLA, was a partner, left, became head of corporate internationally for a firm. It was just being dragged all over the universe, literally. And the thing I missed, and the thing that my partner, Tim Braue, missed, was the ability to really have one-on-one interaction and actually help a client. I mean, really be in there and help a client deal with day-to-day issues and feel their pain and help them build something and be a part of it. And one of the things that we really work for is to sit down with our clients and transform their legal costs into a value set for them by, you know, trying to craft a unique legal solution for their business. So that way, when they come to us and they work with us, they feel a partnership. They don't feel like they're going to get into a cab, the taxi cab driver is going to click the meter and think they're off to the races, and then it's over, the meter gets clicked off, pay me my money, and they're gone. So, you know, we work with entrepreneurs, you know, all of our clients, irrespective of the size that they're at this stage in their company's life or their business, there's an entrepreneurial feature. So we work with startups, two guys in or one gal in a garage working on and watching them grow and build and helping them, being legal advisors, all the way up to them being $500 million companies. You know, our clientele are not only in the Mid-Atlantic region, but you know, it's led us to having relationships with entrepreneurs and entities that are doing business all throughout Latin America, Asia, and Europe. So it's been interesting times for us with COVID and everything going on, and seeing actually some backlash business-wise for some of our clients doing business abroad, being American companies. during these times. But it's been a tremendous experience. You know, I spend my time at the big firms. Everybody actually at our firm is former big firm lawyers and decided to get out, get away, and actually be a part of something. And having become an entrepreneur myself, we feel a lot more kindred spirit with the entrepreneurs and understand a lot of what they're going through. And through that, as you mentioned, it's everything from formations to seed rounds, venture capital, private equity, mergers and acquisitions, and so on.
George, let's pick it up with COVID, actually. Things have changed, obviously, for everybody. What are some opportunities that you see during COVID, maybe that weren't in COVID before? You know, people have ideas, they start to think about things. So what's been happening in terms of opportunities for business in terms of COVID?
That's a good question, Gary. Specifically, if you looked at industry by industry, I think everybody recognizes, acknowledges, and I believe I saw Dr. Ripken on the video today, telemedicine, digital therapeutics, enhanced software and ERM systems, which enable the provision of healthcare in a more efficient way and a better way to protect lives and provide better care, is exploding. You know, I think we've all seen the adoption of telemedicine has become enormous, and it's here to stay. You know, there were times where before COVID, there were discussions about utilizing telemedicine to provide services, and everybody was like, "Nah, if I can't talk to my doctor and I can't see them, I don't want to do it." Now, everybody's grown more accustomed to it because they didn't want to go anywhere, and they certainly didn't want to be somewhere where there were sick people. Telemedicine's become enormous. So I do believe that through COVID, we're going to see massive advancements and are seeing the start of these advancements in how technology can help deliver more effective healthcare to not only the day-to-day individuals, but to help and protect our more elderly population, especially in nursing homes, as well as assisted living, geriatrics, just generally being in a situation where we can learn from what's happened, take what we've learned and develop it for future generations and better provision of, you know, services. You know, we've also seen massive advances in consumer products. And I'm not talking about, you know, disinfectant, antibacterial soap, that kind of stuff. I'm talking about actual delivery of consumer products. You know, the food industry early on in all of this really got hurt, and there were mad runs on beef. We were hearing about poultry farms having massive outbreaks. You couldn't get your Charmin. I mean, you would have think that we were in the middle of a snowstorm again here in Baltimore, and you couldn't find Charmin or milk. But what that did was expose our issues with our supply chains. So now we're seeing advancements and opportunities in how to make our supply chains better, how to make them safer, how to make them more cost efficient. And there's going to be industries that are exploding in that area as well.
George, let's flip that actually for a minute. You know, when COVID started, if I just take a look at the stock market for a minute, all the technology stocks shot up. Everybody working at home, Zoom, Apple, you know, you name it, all these technology stocks. But now that COVID is coming hopefully to a close soon, and with the interest rates rising, things are starting to flip. Technology's valuation is starting to come down, and the cyclicals are starting to come back up again. So my question to you in terms of what you do is, are there any industries that you're familiar with that suffered during COVID, which now that we're about to reopen may come back again?
That's a great question also, Gary. We do a lot of work in industrial services and in business services. And I can tell you, anything that touched infrastructure during the pandemic really struggled. You know, if you were a company that serviced construction, gas and pipelines, oil refining, you know, things like that, that was in a commercial setting, they all got shut down. Everything got shut down. It stopped. And so they really suffered. But now that the cycle's coming back and we're starting to feel like we can get back to work and these things, and we need gas, we need oil, we need our roads to be fixed. We're seeing those companies come back into play. and their revenue cycle is spinning back up and their backlog is increasing exponentially, which interestingly enough has now sparked the M&A market in those industries big time. We are seeing professional money, private equity funds, mutual funds going for, what we call a roll-up, where they're acquiring a bunch of these companies, packaging them together to be an even bigger company. So we are seeing that happening, and we are seeing the spin up. We are seeing, a lot of money being thrown into the food industry, especially clean food. That was listen, let's face it, years ago, we all said clean food. What are you, allergic to dairy? Today, it's become a big thing, and the multiples in the food and beverage space that is clean are through the roofs. So we're seeing the markets, as you stated, where they took a dip. They kind of went into sort of a hibernation. Maybe they didn't go all the way down, but they went down and leveled off. I think what you're seeing in the technology space is an acceptance that we need this technology and everybody's using it. Like, look at us today. We're still on a Zoom. We're not up on a stage giving a panel, waiting for the bar to open. We're still going to have these things, and it's going to continue on. But what you're seeing is a correction in the marketplace and a leveling off, because now everybody's using Zoom. They're using team meetings, and there's so many other platforms that are coming alive that are more specific to certain industries that, you've had this big spike, it's coming down, it's going to level off, and that innovation will be spread into other areas, such as telemedicine and other things that, we'll see it equalize.
George, what about SPACs? Talking about the market, SPACs have kind of put IPOs on its head here. Tell us a little bit about what you're seeing, what you feel, maybe even define what a SPAC is, if somebody out there may not be familiar.
So a SPAC is a special purpose acquisition corporation. What they basically are is a shell public company that goes off and buys companies that are supposed to be within a certain
industry.
But here's the dirty secret about a SPAC. The dirty secret about a SPAC is that they generally drop 30% after, on the trading value after their first acquisition. It's true. I mean, you will hear it from people who do SPACs. They drop in value very quickly. And then you've got the whole positioning of how to take these pieces that were acquired that supposedly have synergy and turn them into an actual operating corporation that's utilized and can build continuous value. It's not an easy thing to accomplish. So I think you probably even heard recently the SEC has announced they're going to start taking another harder look at SPACs. And the reason why is because they drop in value so fast. 9 times out of 10, there's always a little bit of an issue with the companies they actually acquire. And, they're a hotbed for securities law litigation. People lose their shirts with SPACs. So, we have several clients that have been approached by SPACs. I don't do SPAC work. Those years are long gone for me. I try to avoid doing public company work. We do some work for public companies, but I'm not doing their public company securities work. But what we're seeing is a lot of people who have been approached, they immediately, the hands going up. Any sophisticated company today is approached by a SPAC that feels that they have other avenues to secure financing or an exit strategy is not going to go with a SPAC. They're just not.
So George, what you're saying is A, you're not a real big fan of SPACs, number one. Number two, the regular investor is probably going to be left holding the bag while the originators of the SPACs continue to make a bundle.
Absolutely.
Gotcha. Hey, let's get back to the quote unquote real world for a second. A guy's got a business or a gal's got a business and they've had it for quite a while. Maybe they're thinking of a succession plan. Maybe they're thinking of getting out, selling, whatever. How do you begin to value a business, and how maybe has COVID, been with those principles? In other words, has COVID affected the principles of valuation?
Yeah, I would. I mean, we addressed it a little earlier. It depends upon the industry market segment you're in, because there are some industry and market segments that actually saw the multiples that acquirers were willing to pay for businesses to increase, while in other sectors for a long time it was dropping. And as it was dropping, you had a big gap between what was wanted and what was being willing to be given. And then deal structures got really complicated, and a lot of old tricks of the trade were brought back into play with earnouts, seller financing, all sorts of stuff to try to bridge that gap. So COVID definitely, caused some complexity in the marketplace. And then you lay over top of that, what industry are you in and what's going on in that industry and market segment. The act of planning, what we did see early on in COVID and through the portion of it, probably a little past the midway point from where we are today, just this overarching exhaustion on the business owner. I'm doing everything I can. I built this great business. It's moving forward. I was really doing well. COVID hits, half my workforce has to be put on hiatus. I'm fighting to stay alive. I've given a lot of talks about this concept of economic herd immunity, about corporations banding together and trying to work with each other within a sector. I mean, you really did feel it just became really tough. And for the entrepreneur and the business owner and even a family-owned business, they really started looking in the mirror more and more, and they started asking, do I want to go through this anymore? I mean, this has kicked me in the teeth, and I'm cooked. And I'm tired of fighting uphill. I'm tired of swimming upstream. This is just kind of coming to the end. So if you had somebody who's already starting to think about, doing something, and there's, and from a succession planning place, maybe there isn't another family member or somebody within the business to take it over and run it. Their thoughts really started to go to, well, maybe it's time for me to find a buyer, or at least get prepared for it. And there's a couple key attributes when you're talking about a liquidity event, a successful event that enables the entrepreneur and the business owner to say, I did it, I succeeded, I'm going off to sit on the beach. There's a couple things that still you need to do even during times like this, and that's get your house in order. The better the more orderly your house is, as we all know, when you sell your home, you got to stage it. You got to do that for your business. You need to clean it up, paint it, do what you got to do, throw some carpet on the floors, take down all the photos of your dog, and try to make it look something where somebody would come in and see themselves there and taking it over. And so a lot of that goes into, that's when you bring in your lawyer, make sure your accountant's been around, and start to take a hard look at what you've been doing. Scrub the numbers, scrub the legal structure, take a look at your contracts, get your house in order, and build yourself a defensible baseline from which you can set your valuation. That's always been the case. And I think even more now with COVID, it's even more important because there's still a lot of companies out there that would be great buys and could have great exits, but they bootstrapped it. They ran it like it was coming out of their kitchen still, and they haven't taken that time, okay? The market is very hot right now in M&A in certain markets, in certain industries, but it's bleeding across the board. So we're seeing a lot of activity. People refer to it as frothy, like the ocean turning up and the waves are hitting and you start to see the foam. So, I think COVID has heightened the awareness to the warts and that you have as a business and the skeletons in your closet. So it's really important to take the time to address those issues before going to market. If you go to market with those issues, you're done. You can't go back. Once you've been out and everybody sees the warts, and everybody hears about the skeletons in your closets, it's hard to shut that closet door. It's hard to go to the dermatologist. People already know. So, COVID has definitely put a big old flashlight on those issues. The other thing COVID, I would say, has put a big flashlight on is, how did you handle the company during the pandemic? Did you have a team that was capable of reacting to the situation and able to crisis manage through the pandemic? That's got a lot of value to it too. And finally, this concept of herd economic immunity. I mean, we've all heard of herd immunity. And everybody argues it's 70%, it's 80%, whatever it is. herd economic community, the concept is that people within a marketplace, within an industry line, work together in different sectors to try to bolster each other's businesses. Your supplier is working with you as a buyer, as a manufacturer, to ensure that you have what you need, and understands that you are also scrambling to get cash to pay the supplier. Supplier tries to work with you to ensure that you are getting what you need so you can produce product and pay him. You are working with the supplier, with his suppliers, to ensure that he's got a pipeline of stuff by committing to buy. By working together, were you able to work together? And did you utilize this time to build stronger ties within your industry marketplace in order to bolster your business coming out of this, potentially leapfrogging it over your competitors because you've got the better relationships because you did the work during the pandemic to build those relationships? That's a really big thing. Those are really big items that will affect your valuation and will affect whether or not you have a successful exit, and will also affect whether or not you're able to continue the business on through succession planning with your children or with your brother or your cousins or whatever, because you've helped make sure this business stayed stabilized and was strong coming out.
George, unfortunately, our time is short, but how can people get in touch with you personally if they are interested in this topic, which I'm sure many people are?
No, I appreciate that, Gary. I mean, the easy thing to do is go to our website. It's nemphosbraue.com. It's a mouthful. It's NEMPHOSBRAUE.com. That's our website. You can read about us. We've got some case studies and some videos, and our contact information's on there as well. We're always willing to help and listen. We understand, people with a dream, and we also understand people fighting to stay, around.
Yeah.
And we've been lucky during the pandemic. We've been lucky before the pandemic. I'm sure, knock on wood, cross my fingers, we're going to be lucky after that. We've had the opportunity to work with some really amazing entrepreneurs and families and helping them, realize where their dreams and what they're trying to do.
George, always a pleasure personally and professionally to be with you. Thank you so much.
You too, Gary. Thanks again.
All right, you got it. Guys, that'll do it for our program. Hope you've enjoyed it. And we're right on time, actually, about 60, 65 minutes here on the program. So a wrap up here, a thank you to our sponsors, CCBC, Glass Jacobson, Heller Kowitz Insurance, the law practice of Levy, Mann, Caplan, Hermann, and Palashuk, and of course, Nemphos Braue, LLC. And the lineup of our speakers, a big thank you to them personally. Byron Deese from Glass Jacobson, Steve Heller from Heller Kowitz Insurance, David Polashuk from LMCHP, and of course, George Nemphos from Nemphos Braue. Most of all, a big thanks to our participants today for joining us at Jmore's 2021 JBiz, Your Finances, Your Futures event. That'll do it for the program. Hopefully, we'll see you soon right back here on Zoom.